What we're going to talk about today is the financial statements. Remember how when I did that example of the free throws and I was talking about how eventually my coach wanted me to give him some sort of report that would help him make a better decision? Well, now in accounting, we're going to talk about those reports or those financial statements. Let's go to the computer. Okay, now we are talking about financial accounting, which is primarily concerned with the needs of external users. And these are the 4 financial statements that are prepared in financial accounting. Okay, the income statement. Number 2, the statement of owner's equity. Number 3, the balance sheet. Number 4, the statement of cash flows. Now, one thing that I don't think your book makes as big of emphasis as it should is the following. Let me get my pointer out here. We prepare these in this order, okay? So you prepare the income statement first, then you prepare your statement of owner's equity, then you prepare the balance sheet, and then the statement of cash flows. And you have to prepare them in that order because you'll find there's information that we derive from the income statement that you need to prepare the statement of owner's equity, and so on, right? So here's how I know a student doesn't know what they're doing in my class. If I say, okay, let's do our financial statements now, and they're starting on the balance sheet. Well, you can't start on the balance sheet, okay? You got to do the income statement first, then the statement of equity, then the balance sheet, and then the statement of cash flows. You with me? Okay, let's talk about the first one, and that is the income statement, okay? Now, the income statement shows the revenues earned and the expenses incurred for the period, and the resulting net income or loss, okay? This is the most intuitive of the financial statements. As a matter of fact, have you ever heard people say, well, hey, what's the bottom line here? You hear that phrase a lot, right? That actually comes from the income statement. Because look at it. Our revenues for this period were $3,000. Our expenses were $800. So our revenues are greater than our expenses, which makes us happy, right? So we have a net income of $2,200. Now, can a company ever have expenses that are greater than the revenues for a period of time? Oh, yeah. We don't call that a net income. We call that a what? A net loss, okay? So going back to this financial statement, when I say, hey, what's the bottom line here? Well, the bottom line is we have a net income of $2,200, right? So when you hear people say that phrase, that's really where that comes from. Now, sometimes the income statement is called the profit and loss statement, or sometimes people abbreviate it the P&L. You might hear that. But basically, it shows the revenues earned for a period minus the expenses earned, and hopefully the revenues are greater than the expenses, as in this case, and you have a net income. If not, you have a net loss. Now, this is a very, very simple example. They have one revenue and they have one expense, okay? Normally, a company will have a variety of revenue accounts and a variety of expense accounts, and you list each one and total those up and subtract the total expenses from the total revenues. You with me? One very important thing, very important. Whenever you do your financial statements, I'm going to ask you to prepare those in what I call in good form or in proper form. What does that mean? Well, that means this. That means that you need to head these things up correctly. That means you need to first list the name of the company, Scott Company in this instance. The second thing you need to do is list what financial statement is it. In this case, it's the income statement. And in the third case, you need to date it and date it properly. You with me? Number 1 is the name of the company. Number 2 is the name of the statement. And number 3 is date it properly. Now, I will lovingly take off points when you prepare financial statements on your test if you don't prepare them in good form, if you don't give me this information, okay? Because think about it. If you're looking at this financial statement and you don't have this information that's circled, it's pretty much worthless, is it not? Have you ever written yourself a phone number on a piece of paper and you didn't write whose phone number it is, and you find it later and go, I wonder whose phone number this is. It looks important, but I didn't put the name of it. Well, that's kind of like doing a financial statement with not saying who the company is, what the statement is, and what period of time. Okay? All right. Let's talk about the dating of this income statement. It says for the month ended December 31, 2013. Okay? I want to talk about why it's so important that you list it that way. Okay, let's come off that for a second. Kelsey, you have a cell phone, right? Mm-hmm. Everybody has a cell phone, right? If I say, Kelsey, what is your cell phone expense? And you say, my cell phone expense is $150. Do you see how that's kind of a meaningless number or conversation there? Because I'm not, is it $150 a year? That's very cheap, isn't it? Is it $150 a quarter? Is it $150 a month? That's pretty expensive. Or is it $150 a week? Right? So if I say, what is your cell phone expense? And you say $150, now that you have a mouthful of Greek yogurt, you would say, you have to give me more information, right? You have to say, well, it's $150 per month or $150 per week or whatever, right? Look at that income statement. Whenever you list expenses, you cannot just say, do you see how if you just said December 31, 2013, do you see how that doesn't help us? Is this for the year ended? Or is this for the month ended? Is this for the week ended? The quarter ended what? No. You have to say for the month ended if it's a monthly income statement, or for the year ended if it's an annual one, when you're dealing with expenses. Does that make sense? Okay? It's the same way with revenues. Okay? Right? Mpo, you have a job, right? If I say, how much do you earn on your job? And you say, I earn $12,000. I don't know if he makes a lot of money or none, right? Is he saying $12,000 a year? That's what I get paid as a community college teacher. I'm kidding. I get paid more than that, okay? But if it's $12,000 a year, that's not much money, right? If it's $12,000 a quarter, that's not bad. 48 per year, right? If it's $12,000 per month, you'll start dating more, right? If it's $12,000 a week, you're loaded. And if it's $12,000 a minute, you're LeBron James, right? So, take a look at that income statement. Do you see how you can't just say, you couldn't say, consulting revenue is $3,000 and then date that December 31, 2013. That doesn't help us. You have to say for the month ended. Have I hammered that home enough? With revenues and expenses, you have to give a period of time. So I'll lovingly take a point off your test or quiz if you don't prepare those properly and date it properly in good form. Any questions on the income statement? What's the bottom line of the income statement? $2,200. What's the next thing we prepare after the income statement? The statement of owner's equity, or sometimes we just say the statement of equity. Now, the statement of owner's equity is probably the least intuitive of these financial statements, okay? And this is why I gave you the quiz that I did where I said what increases equity or capital and what decreases equity or capital. That's where that knowledge should prove pretty useful here. Because look what decreases it. Withdrawals decreases the balance of capital. Investments by owner increases it, right? Let's take a look at this statement of owner's equity. We have a beginning balance of 0 on December 1, 2013. It's increased by the investments by the owner, like your quiz. It's also increased by the net income. The income is $2,200, and that came from the income statement. That's why we have to prepare the income statement first. And it's decreased by withdrawals. That was also on your quiz, right? Now, keep on this slide here. You might say, now, Dave, I think you lied to us, because it looks like net income increases capital. But that wasn't one of the options on that quiz, was it? I told you revenues increase capital, expenses decrease capital, right? Well, I did not lie to you. All revenues increase capital. All expenses decrease capital. But on the statement of equity, we usually just take the net number over there. Does that make sense? We don't add 3,000 up top and then subtract 800 down below. We just find the net number, and if it's a net income, we just add that to the beginning balance. Make sense?
If it's a net loss, does it go right in the same place?
Very, very good question. If it is a net loss, it's subtracted from capital, and you would put it down here with withdrawals. Okay, you'd say net loss or whatever. Good question. Okay? Does that make sense? So you have a beginning balance of capital. You add the investments by owner. You add the net income. You subtract the withdrawals, and now you have your ending balance of capital. Now, this one is also dated or prepared in good form or in proper form. The name of the company, the name of the statement, and once again, dated properly for the month ended December 31, 2013. It'll always be dated the same way as the income statement. And it's real easy to see that this is for the month, right? It shows you the beginning balance of capital, takes you to the ending balance of capital. Make sense? Now, I want to point out something very important here as well. What's the beginning balance of capital? What number?
0.
0. I do not want you to think that the beginning of balance of capital in the statement of owner's equity is always 0. As a matter of fact, it's extremely rare that it is 0. The only reason it is 0 in this case, going back to that slide, is because this is a brand new company. Are you with me? As a matter of fact, when we do a statement of owner's equity for the month ended December 31, 2014, what do you think the beginning balance will be? Maybe I said that wrong. When we do a statement of owner's equity for the month ended January 31st, 2014, the beginning balance will be what? 21,700. So please do not think the beginning of balance of capital is always 0. It's only 0 here because this was a brand new company. Does that make sense?
If they put cash towards the business, would that go under the
Well, yeah,
capital?
and they did. Look back at that. They invested $20,000 into the company. And
there it is. Okay.
and there it is right there.
Okay.
Cool?
Yeah.
Questions on the statement of owner's equity? You see why you have to prepare the income statement first and then the statement of equity? Okay. Now, back at the slide, what's the ending balance of capital at December 31st, 2013? 21,700, right? Okay, keep that number in mind as we look at the next statement we prepare, which is what? The balance sheet. Here is the balance sheet. The balance sheet describes a company's financial position at a point in time. We call it the balance sheet because it should balance. It's the accounting equation. Assets of 26,900 need to equal total liabilities plus owner's equity of 26,900. Those need to equal, right? If they don't, there's a problem. Okay? Now, let's take a look at it. At this point in time, you have cash of 9,700, supplies of 1,200, equipment of 16,000. You have total assets of 26,900. When you prepare this, you need to put this total, okay, and you need to label it, okay? I don't like numbers at the bottoms of things without a label. That goes back to the income statement. It should say net income of 2,200. And on the statement of equity, it should say ending balance of capital of 21,700. And on this financial statement, it should say total assets of 26,900. Don't just have a total there with no label. Over here, you've got your liabilities, your accounts payable, your notes payable of 1,200 and 4,000 respectively, for total liabilities of 5,200. Then you list that owner's capital of 21,700. Now, where did this come from?
Statement of equity.
The statement of equity, right? Add those up. Don't just leave this number hanging. What is it called? It's called total liabilities and equity, or total liabilities plus owner's equity. You with me? We're not done talking about it. But any questions so far? We prepared this one in proper form or good form as well. Now I want you to notice something that's kind of subtle. Proper form or good form. We list the name of the company. We head it up properly. The name of the company, the name of the statement, and then we date it. Now how is this date different than the previous statements? It doesn't say for the month ended. It just lists a date, and that's proper. There's two ways to do it that's proper. To either say December 31st, 2013 or as of December 31st, 2013. I want to show you why it would be wrong to say for the month ended December 31st, 2013. I'll say that, but you have a question first.
So do you just assume that's as of?
Yeah. It's implied if it doesn't say as of. But here's the situation. Here's why this is a proper dating of this. Whitney, you have a checking account, right? If you called your bank today and said, how much money do I have in my checking account? They would say, as of right now, you have $1,216.19, right? Do you think that's the amount that you've had every day for the last month? No. Snapshot in time, right now, this is what you have. Yesterday it was different. Tomorrow it'll probably be different as well if you're buying some stuff during the day, right? Same way with the liability. Anybody here have a car loan? Okay. If you called up and said, how much do I owe on my liability, on my car loan? And they would say, as of right now, you owe $8,400.44, right?
I wish.
Yeah, you wish? I wish too. I just bought a new car. Okay? But it's not for the month ended or for the year ended. No. Right now you owe that, correct? So a balance sheet is like a snapshot in time. Boom. Let's take a look at that. Right now, as of the end of the day, December 31st, you have cash of $9,700. Right now, at the end of the day, December 31st, your note payable is $4,000. But we don't say for the month ended because that kind of incorrectly implies that that's been that balance for the whole month, and it hasn't. Does that make sense? Now, I know some of this stuff seems very picky, but remember, we're preparing this for other people to look at, right? And it's just as easy to learn the right way as the wrong way, and I want to teach you how to do it the right way. So when I ask you to prepare a balance sheet in this class, I'll lovingly take off points if you say for the month ended December 31st, 2013. I want you just to say as of December 31st, or I usually just say December 31, 2013. And it's implied that that's the end of the day. Cool? Do you see how these financial statements flow from one into the next?